We see a very mixed performance in the S&P in just the last 5 days, but one of the areas that has been hit the hardest is big US pharma, where we see many companies in fact down quite significantly, including Eli Lilly down around 11%. But our focus in the episode today is going to be reflecting on the large Danish pharma company Novo Nordisk. Now, this is one that is down 50% in just the last 12 months. That is, in essence, losing half of their market cap. Year to date, not looking good either, down 24%. And whilst they are trading near their 52-week low, they are down a massive 60% or thereabouts from their 52-week high, and in fact, their all-time high. Now, taking a look at how they formed over the last 10 years, they are up 132%, which we will compare to the S&P's performance, but specifically in today's episode, we are going to cover a wide range analysis of the company and ultimately get to our valuation, which has been lowered, and that is off the back of their latest earnings, which we will cover in this episode and talk about the different points, some looking good, but also some that are a little concerning. Now, we'll also flag that both Wall Street and Seeking Alpha do believe this company is a buy, but actually Wall Street's rating of 3.58 isn't that far off the 3.5 that would flip them into a hold. And in fact, when we expand to all of 2025, we do get a clearer picture that the market is still in the red. We haven't reversed into the green that maybe we are starting to hope for, given news that tariff deals may be coming in the upcoming days and weeks. But that is also reflective when we look at big pharma, at least year to date. Some companies have performed okay, but a lot of them, including Merck & Co. down 24%, BMY down 18%, Pfizer down 16%, have followed the similar pattern of NVO, where it just isn't looking like 2025 will be a strong one for what has typically been some high quality companies. Now, we'll reflect on their valuation to begin with, which a forward P of 15.9 does look very good. When you compare over the last 5 years, it's sat at 30.4. This is what we would call a severe undervaluation signal, not only below the average which is rolling, but also in fact one of, if not the lowest valuations on offer to shareholders over the last 5 years, whilst also offering a yield of nearly 2.5%, well above the average of 1.41, again one of the highest that has been offered. So these two signals in combination do give us a very severe undervaluation point, which is something we always consider in the episode, but never in pure isolation. As we said, we will get to our own valuation process where we will also incorporate some of these assumptions. Now, in terms of looking at another model, the blue tunnel, which gives us the 5-year average P, this essentially tells us the intrinsic value, fair price. First thing to note, it has been increasing over the longer term. That is a good sign, ultimately what you want from companies you're invested in. But we notice massive disparity between where the company sits and the lower end of the blue tunnel, another making it in fact a third severe undervaluation signal, one that has only been increasing from the beginning of the year, getting wider and wider, which is good news for investors who are looking for some good opportunities. But overall, they still get a fairly mediocre rating at a D, although when we reflect on some of these valuation metrics, for example, the PE, forward-looking, sector does trade higher. You are getting a 5% discount, but as we've just highlighted, in relation to their own 5-year average, they're trading 48% lower. In fact, no matter what valuation metric you look at against their own 5-year, they're trading at quite a large and significant discount. Again, that is another undervaluation signal. And against the sector, depending on what valuation metric you like, some of them are showing a discount, some of them are in fact showing a bit of a premium. Our question though to understand in the episode is 1, do they deserve to be trading at a discount in relation to the forward P? Is there something maybe we haven't considered, or is the market giving us a golden opportunity? And 2, what price should we be paying? What in fact is a sufficient margin of safety? Both things we will touch upon throughout the episode, but also worth noting in a more positive tone that when we look at the overall market, many patches of large red, which is highlighting to us that many companies are trading at fairly high valuations, which don't make us consider them in terms of an opportunistic light. But actually specifically to the healthcare industry, other than Eli Lilly, which we will touch upon a little bit, given a very similar company in comparison to NVO, that is the only one that perhaps is looking fairly high at 24.25. Others in the industry as a whole are perhaps looking like ones we can consider in a future episode, Merck & Co., AbbVie, Amgen, J&J, Pfizer, although each one of those may have their own reasons for trading a little bit lower than perhaps some of the others. Now, one thing we like to incorporate into our analysis, whilst in fact not using it as a basis to buy or sell a stock, is what are the analysts believing about companies, because in reality we do believe analysts are more reactive than proactive. They change their price targets, whether that's increasing or decreasing based on old news rather than forward looking, but we have one of many that have started to cut their price targets. In fact, BMO have reduced it down to $64, which would make it pretty much at the price today, meaning they see this at fair value. They are one of many, in fact, as we said, that have been revising their price targets, and we'll come on to why that is as we glance through their earnings. Now, first thing to point out, when they did release their earnings on May the 7th, so just a few days ago, the share price did increase, although bear in mind it has been hit and hard just over the last 12 months. And we can see here that finally in 2025, the copycat of their Wegovy sales is starting to ease this year. Now we'll just show you how much in fact of their revenue does come from Wegovy, as this is fairly significant, but we can see the copycat compounded drugs are starting to be phased out. And if we just take a look at their last earnings, Q4 FY25, whilst nice to see net sales up 30% year on year, one of their fastest growing revenue streams is the obesity care, where we see Wegovy up 91% from the same quarter last year, 21.4 billion, so it does make up around a quarter of their total top line, fairly significant for the company, and as we said, fairly significant news. Now, one thing we didn't like to see is that they reported lower than expected first quarter sales, although they did have a marginal earnings per share beat, but one of a few points that will ultimately affect our valuation is that they've lowered their full year sales growth. Now, as we can see, they note 13 to 21%, and that is below the previous estimation of 16 to 24. That is fairly significant for the company, but that is only one of just a few targets that they have lowered. Now, from their latest investor presentation, we can in fact note that Novo Nordisk have almost tripled their GLP-1 reach, and that is in 3 years. They now hold around 62% of the total market, and one thing that's very interesting to note, not only has it been increasing, but they've also been taking away market share from Eli Lilly, where they held around 37% a few years ago to now sitting at 35%. And we can see the GLP-1 makes up around 50% of their total revenue, 42 out of the 86, and that is up 12% on a year-on-year basis. But given that was the previous quarter, when we look at the first quarter for 2025 Q1, we see some very strong performances. Still, even though lower than analyst expectations, revenue came up 19% from the same quarter last year. We also noticed that operating profit was up 22%, their net profit up 14%, and their earnings per share up 15%. So look, overall it is looking very strong. We can see their gross margin a very small drop, although their operating margin did in fact increase. But overall, one thing we would say, whilst analyst expectations were missed on the top line revenue, earnings per share was in fact outperformed, even though marginally, and revenue does look strong at 19%. The question we need to understand is, what is the growth rate that is already baked into the numbers at this current price, and is this one worth adding near their 52-week low? Now, it isn't just their sales growth that they have reduced. If we go back to February, just a few months from the end of FY24, where they looked at expectations for 2025, they believed revenue would grow 16 to 24%. They've lowered this to 13 to 21. They anticipated operating profit 19 to 27. They've lowered that again, 16 to 24. And maybe the one killer that does affect our discounted cash flow valuation, they were anticipating 75 to 85 billion in the free cash flow. They've now lowered this, and quite significantly, to 56 to 60 billion. And we do want to highlight that in our previous episodes, when we've covered the company, we have used the expectations clearly of the latest available data set. Now they have lowered this guidance. We will be using the lower free cash flow, but worth noting, we have used the upper end, given that some people may argue they are sandbagging their numbers, as they have been performing very well over the last few quarters against analyst expectations, but this is clearly something that will be driving that lower price target. Having said all of that, they still anticipate over the next few quarters to be growth to the EPS. They outperformed in Q1, so they have a 75% track record, 3 out of 4 beats. And in terms of those who like to look at December 2026 projections, EPS 477, they're trading at a forward P of 13.8, which does look very, very low. But one thing to consider, you can't look at companies purely in isolation on their valuation, and those that do look cheap can in fact get much cheaper. Now, the CFO was talking about the latest issues in the economic climate, and no surprises, a few things that did come up, one of them being the global trade wars, and he actually said that he believes at the moment, given everything that he can see in front of him, all of the issues that do look to be cropping up, that they can outmaneuver this and that they stand a very strong chance at coming out of this with very minimal impact. And if we dig a little bit deeper, whilst he wouldn't consider anything that was hypothetical at the moment, for example, Donald Trump talking a lot about major tariffs that would be coming very shortly to the pharmaceutical imports, he iterated that their main concern was ensuring medication was getting to those who really needed it on a global scale, and that their second priority was building the infrastructure in the US, where they already hold 10,000 employees, and in fact they've invested around 24 billion over the last 10 years, and worth noting that they do in fact export more than they do import to the US, and that they're also looking at constructing a $4.1 billion plant in North Carolina where they will be producing that Wegovy, as we said, very strong in terms of growth over the last few quarters. And in fact, now the copycat has been taking out or slowly phasing, it could continue to be a very large growth driver. And even more importantly than all of this, even with their current guidance, which as we already discussed has been reduced from competition from copycats, it doesn't, in his own words, reflect a deteriorating trade environment. So if we get more tariffs that do come out, this is something very important to understand, then the numbers could in fact go lower. But when he reflects on all of this, he does believe that whilst they aren't totally insulated, and as he said, without exposure, they do have a reasonable hedge for many different scenarios that could crop up, one of them being foreign currency hedging, which is something they've already done to help with any of the ongoing geopolitical tensions, and that they hedge between 50 to 70% of their foreign currency reserves. And something else to point out, although we did see a very large increase for Hims and Hers Health when the news was released, and maybe something that does affect them in a more positive way, is that they are now partnering with Novo Nordisk to sell Wegovy on their platform. Hopefully this continues to drive that very large double-digit growth we have seen over the last few periods. And do remember that Novo Nordisk, whilst it is in fact not in the US, is still one of the largest pharma companies, although this data taken from just last year when they were sitting at 592 billion in terms of market cap, they now sit significantly lower at 287. That is just one way that you can identify how hard this company has been hit, and perhaps reminds us that no company is in fact immune to any ongoing disruption, whether that is something internal or external. And Goldman Sachs came up with this narrative of granolas, which was meant to be the equivalent of the US, where they have the Magnificent Seven, and Novo Nordisk was in fact just last year the largest European company. Market cap, as we said, has been hit hard, was 592 billion. But what we're trying to signal here is that SAP, which was quite some way away at 222, has now overtaken Novo Nordisk as Europe's largest company. Again, these are just reflections that when we have companies in our portfolios, companies we're considering, we should always be open to the idea that these companies may not be the best ones for the longer term, and we should always reevaluate them, whether that's after their quarterly earnings, after their annual accounts, or in fact whether we get any data or our investment thesis has started to change because of that. Now, what are the institutions doing where they hold around 12% ownership? We see 4 billion worth of selling over the last year. We get around 50% more in terms of buys, again during the same time frame, but we notice in Q1 we get a lot more, in fact more than double in terms of buying, $648 million, $293 million worth of shares sold. So clearly over the last year, in the most recent quarter, they are very bullish, something we have seen in the previous quarter. Q3 pretty much indifferent, but if you wanted to see a reversal of the trend, in fact quite a significant one, you would have to go quite some way away, maybe Q3 2022, where there was a lot more selling than in fact buying. Point being here is institutions more often than not have really liked Novo Nordisk, and they continue to be buying a lot more shares than they do in fact sell. The other thing we like to do is incorporate super investors to see what they're doing, and right now ownership does sit around 4 in terms of holding this company in their portfolio, And whilst none of maybe the more popular super investors like Bill Ackman, Warren Buffett, Bill Gates hold this in their portfolio, this is something we will make you aware when they release their latest quarter in the upcoming days and weeks, so make sure you are subscribed, notification bell is on. But this pretty much highlights in the most recent quarter where we have data in Q4 and Q3, we see just trimming and in fact selling out of the position, then buying in their overall portfolio. Percentage change is very minimal though, but it's something we like to show just for consistency on the episode. And now getting into the underlying metrics of NVO to see whether or not this is still a high quality company. Dividend safety score sitting at 99, very safe, always good to see. We've discussed these two severe undervaluation signals, and over the last 12 months, latest dividend increase 22%. Always love to see this. This is one of those companies that increases the dividend at a very, very consistently rapid rate, and they were reaffirmed very safe dividend score a few months ago, which ultimately translates to a dividend cut for the company being highly unlikely. Now let's dive into the key metrics for those that believe a recession may be inbound. How did they perform in the last recession, 07-09? Well, they increased the dividend. They had plus 6% sales, which was well above the average of the S&P's negative 12, and they massively outperformed the S&P, negative 27, when the S&P itself was negative 55. As we said, double-digit increases to the dividend isn't something that is new for the company. 22% over the last 5 years, 16% year-on-year over the last 10, something we always love to see. A very strong dividend growth company, and they're also a dividend aristocrat, 25 plus years of consecutively increasing the dividend. Now touching on some of their metrics, for example the free cash flow payout, but as always for newer viewers we do focus on free cash flow over the earnings, which is susceptible to manipulation by management through accounting. Below 60% is what we want. More often than not, we use that because it gives us faith management can continue to increase the dividends at a very attractive rate, fairly consistently around that 60% point, although 73 in 2024, nice to note, expected to come down to 59 over the next 12 months. And then we move to free cash flow per share, where we want consistent growth over the longer term, something we get for the large part, in fact tripled over the last 10 years and expected to continue over the next 12 months to $18.10, always a great sign to see. And then sales growth, as we always say, you want a minimum of 3 to 4% just to keep up in line with inflation. For the large part, it has been strong, especially from 2019, and the last 3 years we do get double-digit growth, something, as we heard from their investor presentation, they are anticipating to continue into 2025. Now we'll cover the total sales in a little bit, but we can see pretty much tripled from 2015 to 2024. But something they also do, in fact, on top of those double-digit dividends, is return excess cash to investor pockets through share buybacks, fairly consistent on a year-on-year basis, but given the share price has been suppressed towards the 52-week low for quite some time, if management do believe the share price is very attractive, maybe we will see a large share buyback program announced. And ROIC, whilst it has been decreasing, we want to see a minimum 10% to give us faith management are able to effectively allocate their capital, and it does look very strong even with this trend now sitting at 44%. Operating margin, now two things we do want to highlight here. One, we want it to be above the minimum 12%, which we see, but the second one, high quality companies, two identifying criteria, increasing revenue, which, let's be honest, majority of companies can do. Second one, increasing margins, something we've noted 43% 10 years ago, now sitting at 48. And free cash flow margin, pretty much a free cash flow machine, very consistently above the minimum and sitting at 25% on a trailing 12-month basis. Then we get to the net debt to EBITDA, the final metric for this point of the analysis. Below 3 is what we want to see, and the numbers you see below are the number of years it would take them to pay off all of their debt net of cash on hand. Looking very low at 0.5, expected to go lower to 0.45 over the next year, so very strong, won't take them that much time, and it does correlate to dividend safety, balance sheet strength, which are both good things that we want to note from companies we're considering or companies we're invested in. Now their growth as a whole does come in at a B. We can see year on year 24%, forward looking around 21. That is well above the sector in the mid to high single digit, but we do want to point out it is also higher than their 5-year average at 18 and 15% respectively, and anticipated EPS growth 14.5% above the sector at 10, but pretty much in line with their 5-year average. does look good overall, a lot better than the sector, and they're also increasing their revenues much faster than their own 5-year average. If we do the same on profitability, they get an A+, gross margin 85%, well above the sector at 60%, above their own 5-year marginally at 84%, and we can see bottom line 34.5%, well above the sector median, which is burning through cash -2%, but also a little bit higher than their own 5-year at 33.7%, so we are noticing some efficiencies here. And cash from operations 19 billion, well above in fact their 5-year average at 11.5%, and also, as we can note, the sector burning through cash -12 million, so looking very strong for the company. And as a quick summary for this part of the analysis, a double buy from Seeking Alpha and Wall Street, hold from Quant. As we said though, Wall Street not far from a hold themselves. D on valuation, B on growth, with an A+ on profitability. Now we'll also just quickly flip to Eli Lilly before we continue with the analysis, as they are fairly comparable companies. Also one we covered in yesterday's episode, so if you want a bit more detail, do check that out. But they're down around 5% over the last year. Year to date, they're also down 5%. Over the last 10 though, massive outperformance of the S&P, up 908%, whilst trading near their 52-week low. Again, it does pretty much mirror Novo Nordisk in that aspect, with a double buy from Seeking Alpha and Wall Street, looking a lot stronger in terms of conviction as well with relation to the numbers. And their Q4, in fact, their revenue was up very rapidly, 45% year on year, but when we look at the comparative to the WeGovy, we can see up 60%, not as strong as what we have noted for Novo Nordisk, but we do also like their margins, looking very good in terms of efficiencies, up 1 percentage point on the gross profit, 13 on the operating, and 9 on the bottom line net income. And also worth flagging that when we look at the same valuation analysis, their forward P of 29, which is well above in fact what we noted for Novo Nordisk, is well below the 5-year rolling at 38. That is one undervaluation signal, but the yield on offer today at 0.82 is well below the 5-year of 1.25, and this analysis also gives us that severe undervaluation signal. Blue tunnel increasing quite significantly, good to see, and disparity between the 2 points, not something we see often for the company. In fact, for the majority of the last 12 months, they were trading in severe overvaluation territory. Again, just something we wanted to reflect on given the two comparatives of the company, but also worth noting when we look at the total return against others in the industry for Novo Nordisk, we have Roche Holdings, Novartis, AstraZeneca, Johnson & Johnson, Merck & Co. These are all similar sector and size. Over the last year, they're down 48%. That is including if you were reinvesting those dividends into the company, and they're only one of two, in fact, alongside AstraZeneca, that are down over the last year. However, when we do flip to over the last 5 years, they go from the worst performing down double digit to the best performing up 123%, and the same conclusion when we look over the last 10 up 184. It is important though to understand that past performance is not an indicator of the future. Whilst they've been one of the better performing over the last 10 years, they could end up being one of the worst, or in fact continue this very strong run. We'll also do the same analysis against the S&P, where there is in fact no comparison. They're down 48% over the last year. S&P is up 9%. Over the last 5 years, however, we do see Novo Nordisk outperform, up 123 to the S&P's 93. Now, even though they have lost 50% of their market cap, it is still worth noting they have outperformed. But remember, things can change very quickly, and you do need to have long-term conviction in companies as they go through many different cycles, whether that's up significantly or in fact down. So it is always worth noting what your investment time horizon is, the conviction you have, because ultimately you could look at a low-cost ETF like VO that does track the S&P 500. Now, we have looked at their revenue and noticed some very strong growth over the last 10 years, going from around 16 billion in 2015 to now sitting at 44. But what we want to identify in this part of the analysis is that does that follow suit? Is that the same story that is being told on the bottom line net income? Not something we always see, but for Novo Nordisk, the answer is in fact yes. It's gone from 5 billion 10 years ago to now sitting at just above 14. So they've grown their bottom line nearly 3 times as much. Very strong to note, and as we said, not something to be taken for granted, as we don't always see this for every single company we review. And then we move on to a very quick health check for the company, total cash versus total debt, where we notice an increase to their cash going from 3 billion 10 years ago to now sitting at 6, which does look good. However, remember, in the balance sheet, we never look at one number in pure isolation. We compare it numerically and directionally to their total debt. and we notice their total debt has in fact been increasing, and quite sharply, going from 156 million 10 years ago to now sitting at 17.2. So their debt is far superior to their cash. That is why we are starting to see the net debt to EBITDA creep up, and why we always say worth considering companies on a quarter by quarter basis, as lots of things can in fact change. For now though, balance sheet does look okay and dividend does look to be secure. And before we do jump in fact to our valuation, we want to let you know we have released our latest free weekly article. We drop one every single Monday morning to your inbox, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month, lots of information for each one, the upside that Wall Street themselves see over the next year, as well as a recently released copy of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. Now jumping into our valuation, we get to $82. This is now updated to reflect what we had discussed in the episode across their latest earnings, and that is derived from one model, the DCF, where we have the free cash flow year on year, including 2024, where we did see a dip of 11%. On average, it is 10% over the last 10 years. However, moving forwards, we have gone for 14% in line with analyst expectations. And as we highlighted, we have now updated 2025 to reflect their lowering of guidance to the future free cash flow. But again, something we pointed out, we have used the upper end, so do factor this in. Now, using the discount rate, we get the present value of future free cash flow and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we get to $82, indicating 24% upside. Now, for those that are a lot more bullish, and for transparency, we will highlight at 16%, $93, indicating 41% upside. And for those that do believe we should be more conservative, at 12%, $72, indicating 9% upside. Now, as typical on the channel, we will use the median rate of 14%, where we're not done there because we always like to apply an MOS, 10%, and we execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that in the episode today, a buy at $74, then we keep going till it's near the current trading price. And in essence, we're saying even after the large drop we have noted from the share price down to near their 52-week lows, and revision to their guidance, in fact, for 2025, including a large drop to their free cash flow, we are still seeing a 20% margin of safety, and Wall Street are still fairly bullish on average, even though we are noticing some analysts cutting the price target down and quite sharp. $95 is what the average sits on right now, and that is still upside of 44%. So give us your thoughts on the overall earnings, the valuation, but do you see it at a buy at 20% MOS and 44% upside? And we'll also show you, for those that want to be a bit more conservative at the 12%, in terms of the margin of safety that is on offer today, you are looking at around 10%. So maybe not as large, but again, this is 12% lower than analyst expectations. And for those that want to see at the 10% point, what we're effectively saying is, given the market value, given the intrinsic price, if they grow their future free cash flow at 10% over the longer term, right now isn't that far off the current value. However, as we have used 14%, the medium, and in line with analyst expectations, this gives bang on 20% in terms of an MOS, and Wall Street themselves 44% upside. So give us your thoughts. Do you see Novo Nordisk still as a buy now? Is it one on your watch list, or in fact is this one that you don't believe fits or is a sell? Do let us know below. As always, don't forget to sign up to the free weekly newsletter. We are dropping a copy on Monday morning to your inbox for free. Grab those spreadsheets, come and join us in the Patreon, where we cover our weekly buys and sells. And as always, have a great day. We'll see you all on the next one.